there isn't enough natural liquidity to cover the exponential expansion of that debt. So central banks like the Fed and the ECB and the Bank of England will do what they do best: click a zero on their balance sheet and debase the currency. And that just creates horrific consequences for the man on the street. The invisible tax of inflation, that causes social unrest, that causes desperation, that causes the working poor to become even more poor. It's a dramatic, as Dalio said, shift now in geopolitics, in politics within our country, in wealth inequality, in monetary desperation, and now global trade desperation. We're seeing this because things are breaking down.
On this episode of What the Finance Podcast, I have the pleasure of welcoming back Matthew Piepenburg. So Matthew is a partner of Von Greyerz AG. So Matt, thanks so much for coming back on the podcast today.
Oh, Anthony, thanks for having me back. Always lots to talk about. Always a pleasure.
Yeah, definitely at the moment. So I'm going to start very broad, and I'm sure we'll go into lots of different directions. What are you currently seeing in the economy?
Well, I mean, again, we have to separate the economy from the markets. Both are suffering, and certainly both are volatile. The economy, as I've been talking about for really 2 years, certainly in the US, but less so, but dramatically still problematic in Europe, is a lot of pain for the middle class, a lot of pain for the man on the street, financial, political, social, etc. Obviously, the US markets, which are a kind of a piggy bank for the world, have just seen, last 7 or 8 trading days of extreme volatility based on these tariff announcements. So there's a great deal of chaos. Some could say it policy-induced chaos, intentional chaos, which we can get into. I see everything through the lens of the bond market and through the lens of a credit crisis, which is always a derivative of a debt crisis. And every market crisis throughout history is a liquidity crisis. So liquidity, debt, bonds, et cetera, are all tied together. It's not an exaggeration when you look at U.S. debt levels, which are unprecedented, when you look at global debt levels that are unprecedented. It is inevitable that we're going to have volatility, crises in the markets, in the economy, from Main Street to Wall Street. So this is something I've been tracking for years. It's only accelerating because the levels of the debt and the levels of the measures introduced to address that debt, what's happening to the currencies, they're all connected. And the measures now since Trump are just getting more accelerated, but the debt problems are still there. And so, again, every market crisis is a liquidity crisis, and every liquidity crisis is a derivative of a debt crisis. And so when you have the US at unprecedented debt levels and the world at unprecedented historical debt levels, we're just a bug looking for a windshield. And that red debt balloon is surrounded by so many needles. In 2019, we saw a market crisis or a repo crisis, which was just a liquidity crisis. Too big to fail banks didn't trust each other's collateral. Repo markets dried up. Fed came in, mouse clicked some dollars, threw some liquidity at a liquidity crisis. 2020, we had the COVID crisis. Stocks and bonds fell together. S&P down 36%. Unlimited QE followed. So you had a liquidity crisis followed by more liquidity, artificial liquidity. Fast forward to 2022, Powell's raising rates higher for longer and his failed war to beat inflation by raising rates. That caused the worst nominal returns in stocks and bonds since 1871. That was a liquidity crisis. Of course, 2023, he had to, at certain points, start to pivot. But then in 2023, we had another liquidity crisis. It was called a banking crisis. But really, that was SVB and First Republic and all the bank failures in 2023. But that was ultimately, again, a liquidity crisis. It wasn't a banking crisis. It was just the bonds that were the underlying bonds in the reserves of these banks had lost value because of higher rates. So that too was a liquidity crisis. And you fast forward to today, or the markets we've seen in the last week, and the extreme swings and the VIX at 52 and intraday trade moves of greater than 10% up or down. That is a screaming sign of another liquidity crisis. In other words, the grease necessary, the dollars, the treasuries necessary to keep a debt-based market and a debt-based economy rolling have all dried up. And so when we're looking at this, and we can get in more weeds of what Trump's effects are and the tariffs effects are, or what the Fed's response is going to be, or what the dollar is doing, it's very complicated, but it's all very simple. All of it stems from a country and a world over its skis in debt and not enough liquidity to match that debt. Certainly not enough natural liquidity from growth, GDP, tax receipts, productivity, the normal things that would keep the grease and keep the engines moving on Main Street and on Wall Street. All of that's drying up because there's so much debt, there just isn't enough grease. And the only way to solve that liquidity crisis, as we saw in 2020 or in the repo crisis or in the banking crisis, is more liquidity. And that, of course, is inherently inflationary at the end. You can have deflationary moments like a market mean reversion or a recession, but the solution is always throwing more liquidity at a liquidity crisis. The problem is that liquidity is man-made, it's mouse-clicked, it's synthetic, it's highly inflationary, it debases the currency. And so you have a currency crisis at the same time as a debt crisis. And even what we're seeing on top of all of that, to add insult to injury, what we're seeing with the weaponization of the dollar in 2022, which was, again, I've said it 1,000 times, the greatest mistake ever made in U.S. foreign policy or the State Department, by weaponizing the U.S. dollar and the FX reserves of a major power like Russia. The BRICS have risen. The data for that we can get into is undeniable. The de-dollarization trend is undeniable. So at the same time that we're having a liquidity crisis, not enough liquidity to cover debt, the world is slowly but clearly moving away from the US dollar and the US Treasury. So that adds insult to injury. So there is a liquidity crisis, a geopolitical crisis, a currency crisis. And we can talk about how that ties into the markets. As for the economy, again, you can look at the SOMs, you can look at the Conference Board leading indicators, you can look at retail sales negative, you can look at consumer spending negative or zero, but for Amazon, that's AWS. You look at mortgage applications down 63% year over year. You look at car loan repossessions, credit card delinquencies. You don't need the NBER to tell your viewers, especially in America, that the U.S. middle class, the real economy, is already in a recession. So, yeah, liquidity crisis in the markets affects the debt crisis, affects the currencies, certainly impacts the gold price. And on the Main Street, we just have an economy which is really the working poor, as I've said. All of the problems and all of the themes, Anthony, that you and I've talked about over the years are simply getting worse. And the question is whether Trump's policies and procedures and incredible activity from Doge, USAID, Greenland, Panama, tariffs, or any of the things, or reevaluating gold or doing a Fort Knox audit, or any of these things actually going to help? And that's the question. Is there a method to his madness, or is it just madness? These are the questions on everyone's mind. But certainly I see, and as I've forecasted for a long time, more volatility, greater risk in the markets, and an absolute recession in the real economy in the U.S. And so, yeah, unfortunately, as I've said many times, I'm no fun at a cocktail party. But the facts are stubborn things, and I don't see real good news in the near term. And we can talk about whether Trump's longer term play makes any sense or whether it's realistic. But for now, it's a very volatile time. Anyone listening can just look back over the last week and see that. But I remind them, go back to recent memory, 2019, 2020, 2022, 2023, and right now. All of these symptoms are a sign of a debt crisis, which means a liquidity crisis. And so this is no surprise. And of course, the solution to those crises is more synthetic money, debased money, and gold is at all-time highs. Again, no surprise. And that's where I'm at in the economy and the markets right now, Anthony.
Yeah, a lot to unpack there. So I guess if we start with the Trump tariffs, as you're saying, they're sort of providing this near-term massive volatility, but then you're sort of saying that that's, I guess, not the major cause. It's this liquidity and there's other factors that are actually really driving the movement.
Yeah. Liquidity, the dollar, again, these things are kind of amorphous, wonky terms in Wall Street terms, but it's really just we don't have enough dollars and there's not enough productivity and tax receipts and manufacture to create dollars. There's not enough demand for the weaponized dollar and the distrusted, over-indebted U.S. Treasury. Again, whether you love or hate Trump, and that's irrelevant at this point. Some think he's a mad genius, some think he's just mad. Some think he's an absolute disaster. Some think he's actually a strong realist. There's no point in debating that because he's here. And so certainly no one cares about my political views. But let's just play it out as it really is happening right now with the tariffs. And in my opinion, certainly whatever you think of Trump, Bessent, his Secretary of Treasury, has a pretty solid understanding of financial markets, the dollar, even gold, and debt. He's far more transparent about debt. than Yellen was. And we have a White House that's far more active than the Biden White House. Again, all these executive orders, all these policies, which some people just think is shooting at the hip, just crazy. For the sake of being the devil's advocate, and again, there's a lot of criticisms of Trump policies, which we can get into, but I think you have to look at through a lens that there is a certain method to his madness. With the tariffs, this is a deliberate policy shock, like we saw in 1971 when we decoupled from gold, because Nixon was desperate to get dollar hegemony back. And ironically, part of that in his trips to China was to get China closer to the U.S. and away from Russia, or then the Soviet Union. What we're seeing in 2025 is a similar policy-induced shock to the global markets, to the U.S. markets, and to the global trade, obviously. But it's very deliberate because, like in 1971, 2025 is an era of desperation, of an unloved dollar, of a de-dollarizing world, and a sense that we need to do something quickly. So the tariffs are clearly directed towards reshoring jobs, making the American dollar hegemonic again. And all of that has to do with the fear of China, in my opinion. The BRICS are many countries, but it's the C in BRICS, which is 17% of global GDP, which is really what concerns the Trump administration and the individuals around him. China is the actual threat. And you have to understand China is more of a threat now post-2022 in a weaponized dollar because China is part of this group spearheading a movement away from the US dollar. Again, 30 countries have repatriated their gold within their own borders outside of the US and other systems. You've got 45 nations trading outside of the US dollar, net settling in gold. You've got the oil trade, which was once sacred to the petrodollar, that you needed to buy oil in US dollars. That created a great deal of dollar love and demand. That's weaning away slowly. 20% of global oil sales outside the US dollar. China buying oil from Russia and paying for that in yuan. Believe me, everyone at Trump, and certainly Besant in those conversations, sees the writing on the wall. And now they think is the time to act, because we have to do something dramatic to get that dollar more attractive, more loved, get China weaker. And if you notice, when these tariffs came out, there was this baseline tariff, and there were 20% tariffs against the EU. There were specific tariffs against Mexico and Canada, and obviously massive triple-digit tariffs against China. In my view, it was very coordinated, very deliberate. The real focus was China. And you'll notice even when he backtracked, and we can talk about why he backtracked with his 90-day pause on the tariffs for other nations, but not China, it's still directed towards China. Even, you could argue, the tariffs directed toward Mexico and Canada are really directed toward China as well, because Besant and others know that if you basically create a wall between China and US, you put this huge tariff on Chinese imports, China will just go into Mexico or Canada, sell there, and then those products can come up through the borders with lesser tariffs. I think one of the reasons he paused is, this is typical Trump bull in a China shop negotiation tactics, but he wants to go back to Mexico and back to Canada and make sure they negotiate that whatever we do to lessen your tariff burdens in Mexico or in Canada, please understand we're drawing the line with China. There's not going to be any secret movements of Chinese goods through Canada or Mexico back into the US. And we're not backing down on China. Again, the idea is to weaken Chinese influence. The idea is we are going to do a seismic shift in geopolitical trade. We're going to isolate China. We're going to force the dollar to be in more demand. We're going to force US manufacturing that was now outsourced to China to come back into the US. You could argue all of those things make sense to make America great again, which is more about making the dollar hegemonic again. That's the best case scenario that kind of explains Trump's policies. The problem is, I think they underestimate China's ability to become creative, and in the BRICS' ability to continue to resist these trade sanctions and to resist this hegemonic policy shock for the dollar. The BRICS are many things, but they're not stupid. They've seen the writing on the wall for generations. They do want to get away from the dollar. They don't want to be under the seigniorage of US dollar. They don't want to be under the seigniorage of the Fed policies, rate hikes, balance sheet expansion, cost effects. importing, basically importing U.S. inflation. They don't want to be under the arms of usurious loans from the IMF or the World Bank. They're not coming back to a hegemonic dollar scenario. They're not going to come back willingly. Trump thinks he can force them back through these tariffs. The question is he underestimating them? And I think he is. And I think the other reason Trump had to do a pause on these tariffs is really kind of tragic. And it goes back to what we spoke about at the very beginning, Anthony, is we're in a debt crisis. And when you're in a debt crisis, if interest rates rise or if yields on the 10-year rise, the cost of your debt becomes even more cancerous and fatal. And what happened, which hasn't been talked about, within minutes of, within a very short period after announcing the trade tariffs, these huge tariffs, and the world going crazy and the markets gyrating, there was a U.S. Treasury auction, and no one showed up. I'm exaggerating, but no one wants to buy Uncle Sam's IOUs. Typically, the U.S. Treasury auction is the primary dealers and other central banks that make up about 16 to 18% of the buying. On the day after the tariff announcement, there was like 1.5% buying of U.S. Treasuries from primary dealers and central banks. I'm absolutely convinced that Besson called Trump and said, it's not working. No one's buying our Treasuries. If no one buys our U.S. Treasuries, I'll be very clear, bond prices go down. And if bond prices go down, the yields go up. And bond yields are the real measure of the cost of debt. And just like we couldn't fight inflation because we were in too much debt, we couldn't raise rates. Powell couldn't raise rates like Volcker because it put too much pressure on our own debt. We couldn't afford our own higher for longer rate policy. Everything imploded. What happened in the last week at the Treasury auctions is we can't even put sanctions on, because if we put sanctions on too heavily and the world reacts and no one's buying our U.S. Treasuries and yields are going up. Instead of Treasuries as a safe haven, people are selling. And hedge funds are selling, we can give you the reasons why, and nations aren't buying, and central banks aren't buying, and primary dealers aren't buying, then those yields go up, and that actually hurts us. So we're too in debt to even launch a successful war on inflation, and we're too in debt to really push these tariffs all the way through, in my opinion. So what happened was those treasury auctions, those rising yields, as the dollar goes down and the markets go down, bonds and stocks going down together, and the dollar going down, in the heels of this announcement, I think the markets called Trump's bluff a little there, because now we're really scared. If no one's buying our treasuries and yields are popping, that means our plan may not be working as well as we think. That's the dark side of this. And again, to be determined. But of course, you can always get those yields down and those rates down if you command the central bank to buy those unloved, weaponized, unwanted treasuries for you. But that, of course, requires QE to the moon, bazooka money, incredibly debasing of our currency. And that explains why gold and precious metal markets are hitting all-time highs, because there's really no way out of this debt trap. And I think though Trump and Besson have said short-term pain, long-term gain, I applaud the idea of trying to reshore jobs, to get those American CEOs who outsource the labor and the American dream to China and other parts of the world, to basically be forced to come back into the US or face these huge tariffs. I applaud that play. The problem is, with our debt so high and our debt to GDP ratio so high, we can't just assume that's going to be done easily, cheaply, or without a mess in the markets or in the economy. And the economy is already in a recession, and the markets can barely handle any kind of volatility. So again, you see the motives, you see the tactics, but everything you're looking at is about debt and about China, Greenland, national security interests. It's about rare earths, it's about metals, it's about other plays. It's about keeping that for us and not for China. The Panama Canal, crazy to some, that's about controlling Chinese trade within our hemisphere, like the Monroe Doctrine. Bitcoin strategic reserve is really, we can get into what that really is. It's really about creating dollar demand because China and other countries are moving away from it. Doge, US aid, all these policies are really about trying to cut down spending, increase interest in the US dollar through the most crazy blitzkrieg events. But it's all tied to debt, Anthony. I want to make it very clear. It's all tied to the fact that we are in debt at levels never seen before in the history of the world, the history of capital markets, and certainly in the history of the US. And when you've got that debt cannonball strapped to your ankles, it makes your policies more desperate, it makes your options more desperate, and it makes the consequences more traumatic. And there is no way around this. I said before he was elected that it doesn't matter who comes into the White House, no matter how much effort, activity, bluster, stupidity, or genius, Santa Claus can't save this debt crisis, and there's going to be more than short-term pain if we stick to this track. There just is, and that's my view on it so far.
Yeah, definitely a lot to unpack there. So I agree with you thinking about, this is all this big show. They were sort of saying that they're going to tariff everyone, but really who was the main target? It was China. And China's the other reciprocate. China's the only one where really the tariffs have stayed on. So it's really this battle against China without them trying to sort of specifically target them.
Right. Clearly. Yeah.
Yeah, definitely. And then, so if we look at, you see this as a complete shift in the world order with what they're trying to do?
Well, Ray Dalio, obviously brilliant for a reason, successful for a reason, has a very strong macroeconomic view. He ran the largest hedge fund in the world. He certainly understands risk assets, stocks, bonds, treasuries. And he's making a strong campaign to explain to the world that we are in an irrevocable shift now, a geopolitical shift, a national political shift, and a monetary shift. And he's absolutely right. These are massive shifts. But actually, all of those things are the same thing, because all of those things are a consequence, again, to my original point, with all the complexity in the world and all the things your viewers have to try and sift through. Keep it simple, stupid, because the debt is simple and stupid. It's simply and stupidly too large to give us many options. And so there is a massive shift because the US has its back into a corner. It's recognizing, even Besant is recognizing, that $37 trillion in public debt is not only unsustainable, it's unpayable. And when you live on debt like that, and you survive by issuing more debt, issuing more IOUs, U.S. Treasuries, and the world is moving away from those U.S. Treasuries because you're in too much debt, and also because you're not loved and trusted anymore since you weaponized that IOU, you're looking at the perfect storm for being unable to continue to extend and pretend with more debt to solve the debt crisis. And so what is the consequence? You're going to have to go back to the old method of monetizing that debt unnaturally through that creature from from Jekyll Island at the Eccles building, the Fed. And you're going to have to debase your dollar to buy your own debt, to drink your own rotten Kool-Aid. The world is catching on. And so these desperate tariffs meant to force the world back into the dollar, just like we forced the world off of the gold-backed dollar in 1971. These extraordinary measures are absolutely shaking up the world. You add a 10%, 20% tax on European goods. If you stick to it, if your policies change every day and countries can't react, it creates so much instability. It creates market volatility. There's, of course, the basis trade for hedge funds that are levering U.S. Treasury, cash U.S. Treasuries out of the repo market. When they see volatility, they dump U.S. Treasuries. And that causes more yield spikes, which causes the debt to go higher. Again, it gets wonky, but it really comes down to we can't pay for or sustain our own debt naturally. We're going to try and do it by policy. And we're going to hope that the world kisses the ring like they did in 1971 and eat the sandwich we're giving them. In 1971, it was, we'll welch on the dollar. No longer is a dollar redeemable in gold. 2025, the new plan is eat this sandwich. You're going to pay more to bring your products into America. Will the world in 2025 react like the world did in 1971? Is America in 2025 what it was already broken in 1971? Will the BRICS and other nations become more creative? Maybe not even retaliatory, just start trading around the US dollar regardless of what Trump says. It's like the French built this Maginot Line to keep the Germans from marching in to France. What did the Germans do? They didn't try to break the Maginot Line. They just went around it. And that's the question. Will these tariffs, will the world bend and kiss the knee of these tariffs, or will many parts of the world, led by China and the BRICS and others, will they simply get more creative, sustain some short-term pain because we all need each other's trade, but just be more creative and find ways around the dollar? That's the gamble that Trump is making. I applaud the idea of he has to bring manufacturing back. We have to get the P back in the GDP. We have to do that. Frankly, I would have put a tariff on U.S. CEOs who made millions and billions by outsourcing job and labor to Asia. Americans have lost 6 million jobs since 2001 when China was allowed into the World Trade Organization. That was less of about American policy, more about American greed at the CEO C-suite level. But again, there's absolutely turmoil that's relating. This is a 1971 moment. This is a deliberate, desperate, and you could say understandable policy shift to try and keep American hegemony from completely falling off the grid. Again, It's not the end of America. It's not the end of the US dollar, but the world is becoming multipolar, multi-dysfunctional. There are bigger players. China is not as strong. It has many problems. We can't just say China and the yuan or Russia and the ruble are going to take over. Of course not. But what we can say is that America isn't what it was in 1990 or 1971 when we thought we had kind of taken over the world. The rise of the BRICS is real. The distrust of the US weaponized treasury is real. The weaponization was fatalistic and horrible for our policies. And that the world doesn't look at us the same way, and they don't look at Trump or the US White House in the same way. Will they bend the knee? And I don't think they will. That's what will be determined. But we have to, you could argue he's just creating so much turmoil to get better negotiations. But Trump's mentality is binary. It's winners and losers. It's not a cooperative John Nash model, beautiful mind model of cooperation. It's just not the way he's wired. And politicians, central bankers, and policymakers from the East to the Europe to everywhere in the world are trying to figure out, is he bluffing? Is he real? What are we going to do? How are we going to react? I think he's not bluffing. He really is doing this. All of these things are a blitzkrieg, but I think it's a little too much too late, but there's no stopping it now. It'll be very interesting to see in the next 3 or 4 weeks, 3 or 4 hours, 3 or 4 minutes, what new changes in the tariff announcements happen, because it's creating so much uncertainty. But what is absolutely certain is our debt levels are too high. We're not the country we used to be. The world will probably not bend to our wishes as they did in 1971. And again, that's to be determined, but I highly believe that the BRICS and China in particular are going to become very creative. And again, I'm not saying that China takes over the world. China has massive problems. It has a massive debt crisis. It has a massive real estate crisis. It has a massive demographic crisis. 60% of its groundwater is rotten from all its manufacturing and pollution. It has to import its energy and import its food. So no, China is not just going to take over, and America is not going to disappear, but it won't be the same America it was 10 years ago in the next 10 years. That to me is undeniable. And I think it's going to be very important for people who are listening to get past just bond market volatility, stock market volatility, and look at history. You know, you had the Dutch Empire, you had the Habsburg Spanish Empire, you had the British Empire, and we have the US Empire for the last many generations. All of those currencies, all of those countries, all of those empires ended because of overextended wars, overextended debt, and debased currency, without exception. The US is no exception to that. But it wasn't the end of the UK. It was just the end of the British Empire. It wasn't the end of Spain. It was just the end of that empire. It wasn't the end of the Netherlands. It was just the end of that currency and that Dutch empire. Things change. There are fourth turnings. Empires live about 250 years, which is ironically where we're at. America's changing. It's not dying. And this market is volatile. It is, it is a bug looking for a windshield. Will this be it? I don't know. Other things I look at. But I do know that the only way out of a debt crisis for us is more debt paid for by mouse click money, which is inherently inflationary, inherently currency debasing. Again, true in every empire's decline. And that explains why gold is rising at such a systemic level, because gold is doing one thing very well. It's holding its value. And gold is in a bull market because fiat money in general and the US dollar is in a clear, undeniably debt-driven bear market. And so gold only has one secular direction, not that it goes up in a straight line. It's very clear why gold is rising. It's not just because US treasuries and US dollars and other fiat money is becoming more and more pathetic. The US dollar has lost 99% of its purchasing power measured against gold since 1971. Gold wasn't doing anything. The dollar was just getting weaker. And that's why the BIS has made gold a tier 1 asset. No one talks about it. A tier 1 asset alongside the US Treasury. It's a far better strategic reserve asset than US Treasuries. That's why central banks have been net stacking gold and net dumping US Treasuries since 2014. And since 2022, when we weaponized the dollar, central banks have effectively tripled their gold buying in just the last few years. You don't need to be a gold bug to see the direction of the hockey puck here. Gold is replacing the US Treasury as a settlement asset, as a savings asset, as a tier 1 strategic reserve asset. That should not be the apologies of a gold executive in Switzerland or me selling my book. That should be very clear to any listener, that this crisis in the Treasury and the sovereign bonds, this crisis in the currency, this unloved, distrusted US Treasury is a crisis of debt, which is a crisis of credit and a crisis of liquidity from my opening point. It's all tied together, and every string we pull on, whether it's tariffs, whether it's Doge, whether it's Greenland, whether it's Panama, whether it's the BRICS, everything is tied to this simple fact of a credit liquidity crisis, which is a derivative of a debt crisis.
Yeah, and I guess the challenge is that you look at, all countries, basically all of them have this debt crisis. It's not, China's not withdrawn from that. They have lots of issues.
No,
Europe,
absolutely.
US. So that's I guess that's the challenge. It's not just that everyone's going away from the US. It's like people are going away from fiat currencies into these assets to protect them.
Yeah, it's fascinating. This is, 2008, we can all remember, hopefully 2008, that was a very severe crisis. 2000, 2001, and the NASDAQ in the dot-com bubble, a very severe crisis. They rhyme, but they're not entirely similar. It was clearly a tech bubble at the turn of the century. The great financial crisis was a mortgage-backed security, subprime, kind of real estate sector-related crisis, which had massive ripple effects in global markets. But China, Australia, other countries were trading outside of that, weren't as affected in 2008, despite the massive pain that caused and the policy reactions that followed. But today, fast forward today, it is a global uh-oh moment because all of these countries are facing, ironically, Russia has a lot less debt than most of the others. That's the great irony. But in general, it's a multi-dysfunctional, new abnormal. But Russia and China and the BRICS and the East are clearly playing chess, as I've said many times, preparing for this years in advance. They saw the writing on the wall with U.S. debt levels as early as 2008. China saw the Bernanke's playbook of printing money to solve a crisis was going to be destructive to the debt and the sovereign bonds. They were already looking away from the dollar. The weaponization of the dollar in 2022 gave them the pretext to get closer rather than further from Russia, and the BRICS became tighter. And you saw their meeting in Russia last year. Their playbook is very simple. We're not going to have a BRICS gold-backed currency. We're just going to net settle trades in a BRICS trading settlement currency, which is 60% local currencies and 40% gold. And that's going to be the new role that gold plays. Even the IMF during the COVID hysteria, the COVID crisis, whatever you want to call it, they had a brilliant PSYOP telegraphing called the New Bretton Woods. It's on the IMF's website. You can click on it for yourself. Christina Georgieva is comparing COVID to World War II. Again, an insult to history, but she did it. She blamed all the debt on COVID, not on central banks, the IMF, or other central bank policies. And she basically forewarned in 2022 what's coming. What's coming is a new central bank digital currency, which is destructive and horrific as it is, has some upsides in terms of transparency, efficiency, et cetera. But it also, in that 2020 New Bretton Woods, and you can literally go on the IMF website, type in New Bretton Woods, and you can watch this cartoon that she created. But she says even then that gold will be at the foundation of this new, I think, grotesque CBDC solution, but it's coming. The train has left the station. I'm not going to stop it. You're not going to stop it. But before we get to CBDC and some type of dysfunctional global reset, the U.S. will do these desperate measures to try and force the world into the dollar and bring manufacturing back and bend and kiss the ring of U.S. dollar and U.S. policy to be determined. Then if that does or does not work, we're still going to go to the Fed. They're going to bring rates down. They're going to print money when markets really tank to sustain the bond market, to keep yields down. That's the Fed's real mandate, keep yields down so that the cost of debt for Uncle Sam isn't too high. And we'll just print more money and debase the currency so gold will continue to smile and get the last laugh in these desperate times. And then after that, don't give me a calendar. I can't predict this with any kind of timing, but I can see the direction. After that, we'll do what the IMF pre-telegraphed in 2020. We'll get together and do a Bretton Woods, a new Bretton Woods. And that is destructive and dysfunctional and as dishonest as that is, because CBDC is incredibly invasive to our civil liberties and privacy. It's a control mechanism. As incredibly divisive as that is, it's coming. And even that has got a gold backing embedded into its DNA. So you see the direction here. The exact weak moment or needle that hits this balloon and triggers these things are impossible to time, but they're all happening. And in the direction for the dollar is weaker, and the direction for gold is higher, for fiat money in general is more debasement, again, because there's too much debt to pay for that with natural fiat money, the natural tax receipts, productivity, trade that would create that liquidity. There isn't enough natural liquidity to cover the exponential expansion of that debt. So central banks like the Fed and the ECB and the Bank of England will do what they do best, click a zero on their balance sheet and debase the currency. And that just creates horrific consequences for the man on the street, the invisible tax of inflation. That causes social unrest, that causes desperation, that causes the working poor to become even more poor. It's a dramatic, as Dalio said, shift now in geopolitics, in politics within our country, in wealth inequality, in monetary desperation, and now global trade desperation. We're seeing this because things are breaking down.
Yeah, and how do you see? You said you think, do you think this will work long term? These shifts for the US?
I mean, again, work long term. I mean, I'm all in favor of the absolute necessity to bring jobs back to America, to bring productivity back to America. Will it work? Well, again, America's not going to die. America's not going to disappear. Will it work? Absolutely, it's going to work, but it's at what price and at what cost? It's going to take more than 2 years to the midterms for this to plan out in any way. And Bessa and Trump, very different Trump now than in his last presidency, isn't worried about the S&P anymore as much. He's more worried about, he's got one term. I believe he's sincere, whether you think he's crazy or not. He does want to help America in the short time he has. He is absolutely blitzkrieging full speed ahead. There's risk to that, but I think, yes, it will work to reshore jobs, which should have never been allowed to go the direction they went. And again, I blame that on the executives of all these companies, not just the White House. That will work, but it's expensive. And since we don't have the tax receipts and the GDP to pay for that, we're going to have to expand fiscal spending, probably higher than levels we saw during COVID. We're going to have to debase the currency. We're going to have a recession. Ed Dowd, a former BlackRock alum, kind of self-recovering BlackRock alumni, admitted if Trump actually wants to be successful, the sign of that success will be a stronger recession, a deeper recession in the near term, because we're going to have constructive destruction. We're going to have to spend even more than we earn. We're going to have to print more money. We're going to have to deficit spend even higher in the interim to pay for this new labor in America, to help reshore these jobs, to stomach the pain these tariffs are going to cause on the shelves at the Walmarts of the world and the Walmarts of the US. There's no free lunch here. Trump admits it, Bessa admits it. The question is just how expensive this lunch is going to be. I think they're underestimating that. None of us can say with certainty. But again, history is a guide. Smoot-Hawley didn't do well for Smoot or Hawley. They lost their Senate seats. McKinley, the tariffs, he lost the election. Those were announced in, I think, March of 1929. Within 2 or 3 years, the markets were down 83%, and we were in a Great Depression. So tariffs can be very painful, and they're not an easy solution. We can debate that, but I think the longer term play, if that's the necessary toll booth and the necessary pain and the necessary constructive destruction we need to bring productivity and manufacturing back to America, some will say that's worth it. It's collateral damage that we have to have a recession and possible market mean reversion in the meantime. Some would applaud Trump. I think Jim Rickards applauds Trump for this. This is the kind of pain and the kind of hard, constructive decisions that have to be made that are going to be messy, but they have to be done to bring these things back to the U.S. So yes, it could be very good for America longer term. And again, as I said, this is not the end of America, but regardless of whether this works and we get a Goldilocks solution with just enough tariffs and just enough reshoring without disturbing all global trade and without destroying global markets, even if we get that just right, which I doubt we will, it still doesn't mean America is the center of the world anymore, the hegemony of the US dollar. Of course, things are going to change. They're unforeseeable and foreseeable. But America, like the former empires of the world, won't disappear. It just won't be the empire that it was. I think that's something that's going to be hard for Trump to fully grasp. But I think that is just the change. And it's not that Russia or China will then be supreme empires. It's just that we're going to go back to this multi-dysfunctional new global disorder. And I just hope between now and then, as Hemingway said, whenever there's a debt-soaked economy or a debt-soaked nation, they'll always buy temporary prosperity by inflating the markets through debased money and inflation. And then we have the permanent ruin, of inflation, and then possibly war. I just hope that in all of these trade wars and currency wars, it doesn't lead to a hot war, which in my mind makes no sense in a nuclear era, but that's beyond my expertise. That's the big risk. But there is no escaping the constructive destruction to come, as Schumpeter of the Austrian school said, whether that's in the markets or whether it's in the real economy. Frankly, the America that I see in Youngstown, Ohio, Toledo, Ohio, Michigan, parts of Pennsylvania, not Palm Beach, Nantucket, Park Avenue, Pacific Palisades, pre-fire, Beverly Hills, Monaco, Zurich. The America that I see in the middle class that I come from is absolutely devastated. And that's appalling. And that's undeniable empirically, but experientially, I see it. So we're already seeing the constructive destruction on the working poor. The question now is how far will the ripple effects go into the global markets, the S&P, the Dow, the NASDAQ, tech, et cetera. I think that we're only just beginning to see the kind of volatility that, to me, is reminiscent of a market topping before a major deflationary implosion in the markets, followed by an inflationary mouse click money magical solution, which is no solution at all because it just is at the expense of the currency. So that's just the invisible tax of inflation subsequent to a deflationary moment that just crushes the average citizen even more. We're at that point where there are no good scenarios left. We just have to be honest about it and accept that. That's where I see it. But no, not the end of America. Could be good for America long term. No free lunch, pain ahead, markets, economy already have a lot of pain. The economy is already in pain. Markets will start to have their day in the dark moment, the dark night of the soul at some point soon. But these are all things that I think are inevitable and unavoidable. And frankly, things that Egon and myself have been talking about for the last 4 or 5 years with more urgency because the signals were really all around us. And now we're hitting that moment where the debt crisis is colliding with a policy crisis. A desperate policy crisis, but you could argue a necessary policy crisis.
And Matt, thanks so much for your time today. Really appreciate everywhere that we've gone. We've gone in so many.
Yeah.
And you said it's consistent, but it is sort of to what you've said previously, but it is slowly starting to unravel. I think that's what we're seeing. But yeah, my last question is, what is one message you want people to take away from our conversation?
Again, I think it's really critical to understand debt. You don't need to be a bond jock or get wonky with yield spreads and yield curves and inversions and all these things, but understand simple concepts, because I understand most people have other things on their mind. They've got other careers, other jobs, other responsibilities. There's a pundit for everything on YouTube every minute. It's exhausting. Understand the history of debt. Again, if you understand that when debt gets too big, things break down without exception throughout history. There are no exceptions to this. Empires change, currencies collapse, centralization becomes more extreme from the left or the right. We're literally living that history right now. In a lot of ways, I'd recommend more understanding of financial history than just the speculation swings in the markets right now. Those are much more complex conversations about how to trade these markets. And that's a whole other many hour conversation. But for those that are just trying to make sense of the senseless, whether it's politics, whether it's markets, whether it's currencies, whether it's foreign policy, it all comes back to desperation. It all comes back to debt and the history of debt. No one can escape it. David Hume wrote about the 1750s. Reinhardt and Rogoff have been warning about it in modern times. Debt destroys nations. And as von Mises warned, in the von Mises of the Austrian school, which is not taught in the West and certainly not in U.S. business schools or banking classes, whenever you have a debt crisis, you have a currency crisis. It's unavoidable. We're literally living that now. It's not projected. It's right now. You're living in this historical moment. You're frog boiling in it. And I really, get past arguing gold versus Bitcoin, stocks versus bonds, new highs, new lows, volatility, all of which are important questions. But if you understand debt and you understand yields on the US 10-year, you'll be able to see why we're this desperate and why we're doing the things we're doing. And you'll be able to see very clearly why gold is not a pet rock that stares back at you and does nothing. Why gold throughout history is absolutely essential right now. And that is not an apology from a gold bug in Zurich. I've been looking at gold for years, but I was a stock and bond trader my whole life. So it's not about an ignorance of banking or ignorance of risk assets. I'm all in favor of speculation if you know how to do it and you're carefully guided. But that's irrelevant to the fact that currencies are dying because of debt. And you have to understand that. And you have to understand precious metals as a preservation asset and not as a speculation asset. It is at an historical moment. That should not be a gold bug apology or a gold bug selling of the book. That should be a common sense understanding of math and history. And I ask people to keep an open mind of that, regardless of what they think of Bitcoin, regardless of what they think of NVIDIA, regardless of what they think of Trump or whatever. Understand debt, understand currencies, understand precious metals, and take a look at it for yourself. And I think you'll see the connections. You'll see the dots connecting.
Yeah, great message. So thanks again. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
Yeah, we're at von Greyerz.gold or vg.gold. We also have the same URL, goldswitzerland.com. All of my articles and interviews, all of Egon's thoughts are there. We talk a lot there on why gold, but also how to own gold. That's free for everyone, whether you're a client of us or not. That's a great resource. There's a lot to be gained from the legacy articles there and some of our pages on risk, jurisdiction risk, ETF risk, bank holding gold risk. It's just a good primer for people that are curious about precious metals, and goldswitzerland.com is easy to find. So I would recommend taking a look at some of the free insights there.
Great. I'll put that in the description below, but thanks again for your time.
All right. Okay, Anthony. Thanks again.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right. Thanks again.